Good morning. This is Mark Boud of Real Estate Economics. It is Wednesday, May 4th, 2011. Thank you for joining us for our weekly webinar series. Our topic this morning is the Southern California economic and housing market forecasts. And we will begin this webinar by showing you the overall shares of transactions for the most recent month for which we have data. Wanted to point out that about 22% of all transactions that have gone on early in this year were associated with foreclosures, properties being lost to the bank. 24% were foreclosure sales, the bank selling properties back to new owners. Because the foreclosure sale rate is higher than the foreclosure rate, we are still seeing a net burn-off or a reduction in inventory, though almost half of all transactions are still associated with distressed housing. New home builder market share is below 3% for the first time in a long time. Usually it's about 18%. Overall resales are about 51%. This is what it looked like a year ago, with new home builder sales at 3.6%, resales at 49.2%, and distressed inventory accounting for about half of all transactions. Back in 2009, here's the market share. This was right after the financial crisis. New home builder market share was also at 2.7% back then. We had more new home inventory back then, but because of the financial crisis, it fell to a low, and it has matched that low during the most recent quarter. And foreclosures and foreclosure sales just absolutely ballooned during that quarter. This is what a more normal distribution looks like in Southern California. About 18% of all transactions should be new home transactions. We haven't seen that in a while. We probably won't see that for several years, as the financial crisis has made it very difficult for any construction lending to occur. There's just very little new home building out there. Most of the market share has gone to distressed inventory and to the resale market. In terms of the overall price and price per square foot trends, you can see that it's been about level during the past 12 months. We have seen a little bit of a downturn in terms of price per square foot and absolute price. That's partly a function of smaller homes selling, and also it's a function of where those homes are selling. But basically, we're still bumping along that bottom in terms of overall value. In terms of the transactions by type, you can see that overall resales have been relatively flat during the past 12 months, and distressed inventory in terms of foreclosures has actually increased a bit. In terms of foreclosure sales, it's gone down a bit, though foreclosure sales still exceed foreclosures, and the new home market share is also reduced during the past 12 months. In terms of distressed inventory, the blue bars represent notices of default, red are foreclosures, green are foreclosure sales. We track these over time. The cumulative difference between foreclosures and foreclosure sales gives you a very good idea as to what the amount of distressed inventory is being held by the banks. You can see that that hit a peak in 2008. Still very high in 2009 and 10, though it's trending downward. We think that that downward trend continues, despite the fact that foreclosures have not necessarily declined dramatically during the past year, nor will they much during year 2011. We'll still see a net decline in distressed inventory because foreclosure sales are exceeding foreclosures throughout Southern California. Here are the overall construction patterns. You can see that we're bumping along an all-time low in terms of construction, new home construction. We haven't really felt the impact of that very low supply, because if you add distressed inventory to that, which this chart does, it brings it to a more normal level of overall supply, an average level, I should say. And it's not until 2012, 13, and 14 where we continue to see reductions in overall supply, despite the fact that we'll be building more new homes. The burn-off of distressed inventory means that there'll be an overall continued downward trend in supply patterns, which is a good thing. And what that means is that as new home supply builds, it won't necessarily translate into dramatically increasing levels of competitive supply, because we're burning off distressed inventory. At the same time, the economy will be improving, and more demand will be created through that economic growth. Let's go into that. Here you can see the overall job levels. We hit an all-time low during year 2010, and we'll build from there. though even by 2015 we don't expect to hit the high water mark we hit in 2007. In terms of 12-month changes, I wanted to point out here we are in February. That's the most recent month for which we have data. From February 2010 to February 2011, we created about 73,000 jobs throughout Southern California. It was a strong job report, and you can see our 12-month forecast continues at or above that level. We break it out by year for the next 5 years hereafter. Here, our overall job growth pattern for year 2011 is 63,000. Now keep in mind we made 75,000 during the past 12 months. And so we've already exceeded that, meaning that our forecast for year 2011 may very well prove conservative. And we hope it does. In terms of job change by industry during the past 12 months, from February 2010 to February 2011, you can see that we're still losing an enormous amount of government jobs. We think, unfortunately, that continues for the next several months. Construction job losses continue, but they are falling, or at least they are getting closer to equilibrium. And we're seeing very significant growth in professional and business services, education and health services, leisure and hospitality, information, even manufacturing is positive, as we're seeing fairly strong growth in high-tech, in biotech, and in green tech. This is what it looked like a year ago. So in terms of the overall job change during the past 12 months, it's far better than where we have been. We are making progress. It's not felt in the markets yet because there's a significant lag time between economic change and market change. But at least we're heading in the right direction now. In terms of mortgage rates, you've seen this forecast before. We're about 4.85%. We think we head towards 7% during the next 5 years. Keep in mind that that's more the norm. It's really the abnormal situation is right now below 5%. We think that it goes up over time because of national debt as well as national economic growth. Population trends will be skewed toward 55 to 74-year-olds during the next 5 years. Not a lot of growth in the younger age brackets, but there's still a lot of population in those age brackets, so they can't be ignored in terms of overall demand. It's just that the change is mainly focused on 55 to 74 due to maturing baby boomers. All of this information translates into our demand and supply model. The demand curve is shown as the green curve. You can see that it fell apart sharply in 2007 and 2008 as we lost a lot of jobs. And now we're beginning to trend upward again, though we're still well below supply, which is shown by the blue curve. The difference between those is shown more dramatically here. This particular recession that we've been in, which has been very painful, has been a bit more deep than what we experienced in the late 1990s, and will be about the same in terms of duration. However, you can do well. You can sell homes in an oversupplied market, in a distressed market, if you're also undervalued, and that's where we are right now. The green curve in this particular part of the model shows where we should be in terms of overall price based upon where our income levels are and where mortgage rates are. Obviously, this increase in affordability during the past few years has been caused by significant drops in mortgage rates. In the meantime, we've overcorrected from the bubble that we were in. We overcorrected hard because of the financial crisis, and we're still at a very, very undervalued state. Seen more clearly here in terms of this level of undervaluation of homes. It's almost as unstable right now as it was back in 2007 and 2008. It's just the flip side of the equation. This needs to be forced back to equilibrium, and it will be forced back to equilibrium through a combination of increases in mortgage rates as well as price appreciation. It'll take years to do that, but that's simply the nature of the cycle. We think that by about 2015 we'll be hitting break even in terms of value. So those that can purchase right now or during the next couple of years will be able to take advantage of unprecedented levels of undervaluation throughout Southern California. And unless you think that the level of oversupply that we have right now will continue forever, then it's probably a good decision to make a purchase now. In terms of the forecast of price appreciation in percentage terms, it's shown here for the next 5 years. Starts out very low. This year is quite a bit less than last year. Last year we had a bit of a rebound and a reaction to severe undervalued levels. Now we think that those coastal markets see a mild single-digit price appreciation, and the Inland Empire is probably about a break even at zero. The overall net or composite impact is about 1.5% positive, and it goes up from there as the economy continues to grow, as distressed inventory burns off, and as new home inventory remains very low. Even with that economic or that price appreciation forecast, by 2015, we really don't even hit 2004 levels in terms of price. And we think that this is more of a stable price than it was in 2004, which was the beginning of a bubble. Here are those overall patterns in overbuilding and underbuilding, overvaluation and undervaluation, and the resultant composite index I call the opportunity risk index, which suggests that based upon a strong index in 2009 and a typical 24-month lag time or lead time, we should be experiencing strength this year, 2011, and we will see pockets of strength, especially in Orange County. But keep in mind that we've gone through such a severe recession, we think that the lead time between this index and actual market manifestation is probably longer. It's probably closer to 36 months, which means that actual market health really doesn't occur throughout the entire region until about 2012. I wanted to show one more chart. This is our stab at a very long-term forecast in terms of price appreciation. What I wanted to point out is that we've seen hyper cycles of price appreciation many times. It happened back in the late 1970s with double-digit appreciation, late 1980s with double-digit appreciation. We hit it again in 2001. We should have corrected there because we were experiencing job losses, but instead we deregulated the mortgage market, which caused a lot of artificial demand to enter into the system, and we created this bubble, and unfortunately we paid the price for that. But because we've dropped so much in value, we're really at the base now of another what would be considered a normal cycle of price appreciation throughout California, and that really translates to double-digit appreciation. We think our best estimate beyond a 5-year forecast, which we usually do, is that double-digit appreciation occurs in 2017, 2018 before it crashes again. Neither the peak nor the trough next time will be as severe as it was during the last cycle, partly because we'll have regulations in place to stop that. That is our presentation for this morning. We thank you for joining us. Those of you who want information regarding our consulting services, please feel free to contact myself or John Mulville. Regarding our online information tools, please feel free to contact Judy Duell or Sandy Rivera. And we hope you'll join us next week for our continued series, webinar series, that will be posted on YouTube. Thank you.